Today, we're going to unravel a story that involves your morning coffee, billions of dollars, and a legal showdown between a global giant and the European Union. This isn't just about Starbucks. It's about cracking open the playbook of how massive companies play the global tax game.
It all comes down to this one mind-bending question. How can a company, a huge one, sell billions of dollars worth of stuff, but then turn around and tell the tax authorities it barely made any profit? This isn't just a riddle, it's the very heart of the Starbucks tax case. And the answer is, well, it's complicated.
All right, let's get into it. And look, this case is way bigger than just one company. It's really a masterclass in international tax law, a world filled with these incredibly complex, often controversial rules that are always being pushed to their absolute limits. So, in one corner, you've got the European Commission. Think of them as the EU's executive branch, and they're also the watchdog for fair competition. And in the other corner, Starbucks, one of the most recognizable brands on the entire planet. The fight was over tens of millions of euros in back taxes, and more importantly, about setting a huge precedent for how corporations like them get taxed. Okay, so before we dive into the nitty-gritty of the case itself, we need to understand the playbook. We've got to get on the same page about a couple of key ideas that, people often mix up.
First up is tax avoidance. Now let's be super clear. This isn't about breaking the law, it's about bending the law. It's really the art of finding and using every single legal loophole you can to pay as little tax as the law allows. It all happens in this kind of murky but technically legal gray area.
And it is absolutely crucial to know the difference between that and tax evasion. Evasion is straight up illegal. We're talking hiding money, lying on your tax forms, that kind of thing. Avoidance, which is what we're talking about here, is all about legally structuring your business to follow the letter of the law, even if it seems to fly in the face of the spirit of the law. So how do they actually do it? Well, one of the main tools is something called transfer pricing. Just imagine for a second you own a really popular bakery. You also happen to own the mill that supplies all your flour. So the question is, how much do you charge your own bakery for that flour? If you set the price really, really high, the bakery's profits are going to look tiny, right? But the mill's profits will look huge. And if that mill just so happens to be in a country with a super low tax rate, boom, you've just legally shifted your profits. That's transfer pricing in a nutshell. Now, to stop this from getting totally out of hand, there's a big international rule called the arm's length principle. This thing is like the bedrock of global tax. And all it says is that your bakery has to pay your own mill the exact same price it would pay some random independent mill on the open market. The entire Starbucks case really just boils down to one question. Was their pricing really at arm's length?
So, with those ideas fresh in our minds, let's peel back the curtain and see how Starbucks actually put together its European operations. And believe me, this is where it gets really interesting.
I know, this diagram looks like a crazy tangled mess at first glance, but it's actually a brilliantly simple roadmap. Don't get bogged down in the details just yet. Just follow the beans and follow the money, and you'll see exactly how this whole thing was engineered. Okay, let's break it down into 3 simple steps. First, a Starbucks company over in Switzerland buys all the raw green coffee beans. It then sells those beans at a big markup to the main Starbucks roasting factory in the Netherlands. Step 2, the Dutch company roasts the beans and sells them to all the coffee shops. But here is the real kicker. A third company, this one in the UK, owns the secret recipe, the roasting know-how, and it charges that Dutch factory a massive royalty fee just for using it. So what happens? The Dutch company, the one doing all the real work of roasting, ends up with sky-high costs. It's paying a ton for the beans from Switzerland and a fortune in royalties to the UK. This means its taxable profit there in the Netherlands gets squeezed down to almost nothing, even though it's supplying a massive market. The profit has been cleverly and legally shifted somewhere else.
Well, this very, very complex setup eventually caught the attention of the European Commission. They started to suspect that this wasn't just clever accounting. They thought it might actually be breaking some fundamental EU rules about fair competition.
The weapon the Commission decided to use here is a concept called state aid. See, in the European Union, it is generally illegal for a country to give one specific company a special economic advantage, like a sweetheart tax deal that its competitors can't get. The whole point is to keep a level playing field for everyone.
Now, to prove that this was illegal state aid, the Commission asked to pass 4 tests. Was there a state intervention? Yep, the Dutch tax authority signed off on the deal. Did it affect trade and distort competition? The Commission definitely argued it did. But the entire case really hinged on that second question.
Did this whole setup give Starbucks a selective advantage?
The Commission's argument was pretty straightforward. They basically said the Netherlands gave Starbucks a tax ruling that just rubber-stamped a completely artificial system. They argued that the royalty for the roasting know-how was ridiculously inflated and had no real economic justification. And in their eyes, this all added up to a special deal that lowered Starbucks' tax bill in a way that just wasn't available to other companies.
So the Commission laid down the law and ordered the Netherlands to get back up to 30 million euros in taxes from Starbucks. Starbucks in the Netherlands immediately appealed. And then, in a decision that honestly shocked a lot of people, they won. Let's dig into how.
Okay, this slide right here is the absolute key to why Starbucks won. The Commission attacked the method Starbucks used to calculate its profit. They said it was artificial, it was wrong, it wasn't arm's length, but the court basically came back and said, and so what? See, it wasn't enough to just show the method was flawed. The Commission had to prove that this flawed method actually resulted in Starbucks paying less tax than a normal method would have. And that's exactly where their case just fell apart.
This one quote from the court really says it all. The case wasn't about what seemed fair or if the corporate structure looked, a bit weird. It was a cold, hard question of proof. The Commission argued that the structure was artificial, but they just couldn't prove to the court's satisfaction that there was a specific, quantifiable economic advantage.
So here's the bottom line, the key legal point. The court didn't say the Starbucks setup was perfect. It didn't even say the arm's length principle was applied correctly. All it said was that the EU Commission had not met the very high legal standard required to prove that this tax ruling was illegal state aid. It was a technical victory for Starbucks, pure and simple, based on the prosecution failing to prove its case.
So Starbucks gets the win on a legal technicality. But a victory like that, it leaves a bit of a strange taste, doesn't it? It kind of forces us to step back from all the courtroom jargon and ask a much bigger, more fundamental question. If a system this complicated can be designed, defended, and ultimately win in court, is the problem really with the company, or is it with the rules of the game itself?
And that's why this case has such huge implications. For one, it shows just how hard it is to use state aid law to fight corporate tax avoidance. It puts a spotlight on the insane complexity of trying to police the internal finances of a global company. And it just pours gasoline on the fire of this huge global debate. Is the century-old international tax system even fit for purpose anymore? And that really leaves us with the final thought here. The court decided that Starbucks didn't technically break the rules, but the whole affair forced a much more uncomfortable question out into the open. In a world of global brands and digital services, are the tax rules designed for a totally different economy, fundamentally broken? And if they are, what on earth comes next?